Hey there, we are live. Thank you so much for joining me. I'm Mitch Goldberg. This is the market update. I call it Be the Boss of Your Money. It's not just about the stock market, how the market did today, what's the latest, like it's about financial education. It's about putting years of experience in, into the show, conveying to you that there's more to uh, good personal finance in the stock market. Okay, that's a couple of things I want to get out of the way. We had a pretty good day today, and we are at the highest levels in the stock market as measured by the S&P since April of last year. So we are at new year highs for the stock market. Stocks like Boeing, for example, a large industrial, hit a new year high today. And it's really the upside is spreading from just a handful of technology stocks to some banks, some industrials, drug stocks. It's really starting to take hold. We've been talking about this for months. Really, I mean, I know a lot of people say, "Oh, I said this, I said that," and maybe they did, maybe they didn't. But I have, I have proof. I have the live stream. You watch the show, you know. I've been saying investors must be prepared for the stock market to go up, for the stock market to hit all-time highs. And why would you invest in the stock market when you could just save your money in the bank or put your money in a CD earning 4 or 5%? I'm not saying you shouldn't do that. But what I am saying is over time, CDs, short term CDs, money markets, savings accounts, T bills, other short term stable securities and cash equivalents, they are not volatile. They're pretty steady. You know what you're getting, you know what you're going to get, you know where you end up when these investments mature. Like a CD, you know what you're getting out of it. And that's a good thing. I think that's a great thing, actually. I think it's a good thing for the money that you need to keep in a savings account or an emergency fund or in that rainy day account for the rest of the money. Oh, and for money, of course, you're going to need in the next year. That's savings, really, though, right? I mean, we know what our expenses are going to be in the next year or so, especially if you're retired. You should know more or less what your expenses are going to be, and you should have that money that you're going to need over the next year, could be next 2 years, set aside in cash. The rest of it could be invested. Invested in what? That's a different story. We talk a lot about that here, but that money could be invested. And this way, you know that you have a reasonable shot of staying ahead of inflation, of actually seeing your money grow. If all we had to do is save money, we would save money. It would be a lot easier to save money than to invest money. It would be a lot less exciting, which is, I think, a good thing for personal finance. But the key is when you invest money, saving money, well, just savings usually proves to be inadequate for long term growth of your money. The reason people have more money over time who invested, who did it right with saving and investing is because the investing money compounds historically at a much greater rate than just a savings account. So people's money grows a lot. So people put a few $100,000 away in dollar cost averaging, for example, into a retirement plan, could end up with $1 million or more when they retire. You're not going to get that from a savings account. Now, I do realize that the stock market goes down, duh. The worst is when the stock market goes down in that 5 years or so before retirement and that 5 years or so after retirement. But you're talking about a 10-year span, and you'd have to expect that the stock market will go down several times and several times go down hard in a 10-year time frame. But that's where we put aside some money for savings and an emergency fund so you don't have to tap your investments to raise cash. Because if you do that, you get hit with negative sequence of returns where you're selling more shares because the market is down to raise the same amount of money to pay for your expenses. And then you wind up having fewer shares in the market to recover and to compound going forward. And it becomes a source of fuel burning for for your portfolio? Let's roll the intro. We're going to talk about a couple things, and then we'll be off. Here we go. Thank you so much for joining me. Got a couple of you out there. And while you're watching this, if you have a question, words of wisdom, hit me up in the comments. That's what they're there for. I love hearing from you. It's the best part of the show. We have Joshua Picau. And if I pronounce your last name incorrectly, Joshua, please let me know, with the double rockets. Typically we talk about rockets with meme stocks, but I think you're just being supportive. So I do appreciate it. Thank you very much. And if it was about meme stocks, that would be okay too. It's open to interpretation, right? That's the emojis. Daryl, my man, I get such a nice compliment from you. Mitch Goldberg is a financial beast. Y'all better recognize. Can't wait to see the new studio, D. Clark, aka Creative Thought Scientist. Daryl, I hate to disappoint you, but this pretty much is the new studio. My last studio was also my office, but I was able to do a lot more sound treatments, and it took me a long time to get the studio that way. So I'm working on it though. I'm doing a lot more in this office to make it more look studio-ish, but it's going to take a little time. The first thing I had to do is order new cables, 2 new XLR cables, and a new USB-C to USB-A cable, because the cables I have are all wrong size for this new space I'm in. I was in my last space for 7.5 years, so I had everything set. So it'll take a little bit of time, but you'll see it'll become studio-ish as time goes on. And we've got here, exactly, you can't outsave inflation, but investing can. And isn't that the truth, right? I have to say, historically, that's been the truth. But past performance is no guarantee of future performance. I also have to say you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And then I have to say diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And then I have to say I don't give tax advice. If you need tax advice, speak with your tax advisor. I will talk about taxes in the scope of what they have to do with investing, things like that. I can say that you owe income taxes when you take money out of your IRA. It's considered income. However, having said all that, last thing I have to say is I'm not your mama. I'm not your papa. But if you need a financial expert, investing, saving, budgeting, personal finance, getting ready for retirement, and if you want somebody to uncover opportunities, the opportunity that you probably missed when you inspect your own financial situation, if you miss the opportunities that could help further your goals, that could possibly help your money last longer in retirement, you reach out to me. Send me a DM. Check me out, clientfirststrategy.com, or just Google me. You'll see all kinds of good stuff will come out, and we will get that going. All right. And one more comment before we get into the heart of the matter. Renee, hey Renee, thank you so much for joining me. I haven't seen you for a while. Look, I must say, I took like almost 2 weeks off. We moved offices 2 weeks ago. Last week, I literally unpacked the boxes, set up the cameras and the computer, and Thursday was the first live stream I did last week, and I'm back to doing it daily. My man Mitch, thanks for all this helpful info. Is this the new office? Yes, it is. I have to post more pictures on. I have to post new pictures on social to show you guys. I'm just waiting for some wall art. Maybe I should just not wait for perfection and show the office as it is now. I think that's what I'll do. It's looking very good. It's very neat. Hasn't gotten cluttered yet, so that's clutter is on the way. Let me switch back to camera 1. And I won't have to reach over like this every time I switch cameras within the studio. I'm going to just take a little scooch back. Take a little scooch back. Jerry, nice new home. Thank you, my man. Jerry actually got a video tour earlier today. Jerry's a good friend of mine, and I took him around on on Messenger. We did a Messenger video call, and I showed him around the office, and we checked it out, and it was fun. So thank you for that, Jerry. All right, so a couple of things you may have noticed. I read about this in some media outlets, but Robinhood is offering 24-hour trading on the weekends now. So congratulations to all who have 48 more hours to make really bad financial decisions. We know that the less you trade, the better off you are. And we know that the more you trade, the worse you do. So I have to just give you my explanation of what's the difference between investing and gambling. With putting money into the stock market, investing, the longer you invest, the higher your odds are of winning. With gambling, the longer you gamble, the lower your odds are of winning. And the worst is when you do hit it right early when you're gambling and you start to think, wow, this is easy. This is good. I'm on a hot streak. This is my night. Yeah, good luck with that. All right. So a couple things going on and that we need to address. The big picture is this. Inflation the inflation numbers, consumer price index numbers coming out tomorrow morning at 8:30. Tomorrow morning, you could tell them from Long Island, tomorrow morning at 8:30 a.m. It's expected to be 4% year over year, which it puts it at its lowest level. And since inflation hit 9% over a year ago, and it's expected that the Federal Reserve, the FOMC, Federal Open Markets Committee, meets tomorrow and Wednesday at around 2:15. The Fed will announce its policy, what they're doing with interest rate, with short-term rates, if they're going to raise it, lower it, or hold it steady. The expectation, big time, 72% or higher expectation, according to the CME Market Watch. They are looking, streets thinking about 75% chance the Fed does nothing on Wednesday. I wouldn't be surprised if those odds have gone even higher, because as the stock market has risen today, that is really a reflection of the optimism that the Wall Street expects the Fed to remain on hold for a while. They might come back in July with another rate hike, just one last hike, just to let everybody know that they really are vigilant about fighting inflation. We'll see what they do, but we do expect nothing on Wednesday unless we get like an outlandishly high inflation number tomorrow, which could happen. We don't know in advance what the number is going to be. I'm just telling you what the expectations are. The problem with expectations, when everybody expects something, if we get the opposite, it really it could be a crushing blow to the market short term. And if we get what everybody does expect, usually the market's already up on anticipation of that, and we start to sell off a little bit. So having said that, the stock market reached its highest level in over a year. The S&P 500 went through a major barrier, I'd say breakout zone, right? Stock market is in breakout mode now because the S&P closed over 4,300. That's a pretty big deal, and by all historical counts, we should see the stock market continue to trend higher, because after a bear market, which conceivably is over because the S&P 500 has rallied 20% or more from its bottom last October, that would mean the end of a bear market in our definition, and a new bull market has begun. And we'll see if it's true. Usually that's what it means, except for two glaring examples. The first, after 9/11/2001, the stock market turned tail and went back down to lower lows, kept going down right through early 2003. And in 2008, the stock market was starting to recover, but turned tail and went lower through the end of 2008 when Lehman blew up, all the way through March of 2009. And it was a severe down market. Way worse than anything we saw even with the COVID pandemic in 2020 and with what we saw this past October. So those are two times when the stock market went 20% above a recent high, and we thought the low was in, and the market went lower. So it's a rule of thumb, and a rule of thumb works because they work just enough to suck people into them until they don't work, and then people wonder why they ever paid attention to something so silly as a rule of thumb. So I do think it's reason to be optimistic, and I've already said here that I do think we're going to new year highs this year. And as you're starting to see analysts get more excited about it, they're starting to up their targets and all that. And the S&P 500 is maybe 9% away from an all-time high. It's very doable, folks, because on individual stories, it's possible for this to happen. Let's take a look at the tape. Just have to reach over here and pop myself in the corner. All right. I won't be doing that leaning over pretty soon, but it's a new studio and I don't have the cable length to pull my camera switch over within arm's distance. I have to keep leaning over like that, which I can't stand. Not particularly good for the production value. But let's see. The Dow is up almost 190 points. Nasdaq was up over 200. That's a pretty significant day. S&P 500 up almost 1%. Gold continuing to come down. This is striking to me. Oil is just sliding down the slippery slope. Slippery slope. Oil. Okay. Down about $3, $67. It just seems that the more the Saudis raise hell about oil, the more they decide to cut, the lower the price of oil keeps going. And that's because OPEC has lost control of the oil market. Russian production has essentially recovered since the beginning of the war with Ukraine. And they have buyers for it. Buyers are paying below market price, India and China. And you have Iran who's pumping, and you have Venezuela who's pumping. If companies are getting around sanctions, we can't enforce every single sanction all over the world, and countries know that. In fact, we're actually pulling back from the Middle East in a lot of ways. For example, recently I think there was one or two ships that were detained by the Iranian Navy carrying oil. There were Turkish flag tankers carrying oil to China, and normally you would see the U.S. Navy enforce the rules of the oceans and to keep, seafaring lanes open, and we just ignored it. And no, it's not a sign of weakness. It's a sign to say that we don't need to pay for it anymore. We don't need to bother with it anymore. You guys want to fight over your sea lanes and your oil? We've been helping everybody since 1950. That was the key. We convinced Europe to give up their security and we'll defend you. And we defended maritime laws, and now we don't have to do it because we don't have to really worry so much about oil, where it's going, where it's coming from, because we have our own. That is probably the biggest geopolitical change, in the modern era. It's really just a huge change, and that's why you keep seeing oil go down. We no longer have to worry about it. If Iran and Saudi Arabia go to war, yeah, it'll hurt the oil market, but I don't think it's a death knell anymore. Like we used to think how awful that would be, but now, all right, whatever. Between Russia and the United States, we've got more than enough oil. The VIX was up a good amount. Now this is odd because the VIX was up 8.5%, while the major stock market averages were actually up. That's a little odd. Usually, when the stock market goes up, the VIX would go down. The VIX is the volatility index, also known as the fear gauge. And if we see the VIX go up, that means large investors who can afford to hedge are paying for hedges. And you could look at this in a couple ways. You could look at it as a contrarian sign that if the VIX goes up, that's good. If the VIX goes down, it's bad. Or, you could look at it, it's good. This is all open to interpretation. That's the beauty of the stock market. And that's where perspective comes in. That's what I'm bringing you. So I think the fact that the VIX went up today is a sign that stocks are getting a little stretched, a little complacent over the near term. We've had a lot of bad news. The market climbs the wall of worry. And then we've had a lot of good news lately with the stock market, with individual stocks. Like, for example, Boeing, I said, hit a new high. All right. 52-week high. This is a major industrial company. And then you take a look at Oracle. which just came out with earnings after the close. And or I'm bringing up Oracle now because it did come out with earnings after the close. But this was a darling of the tech stocks in the 90s and early 2000s. You don't really hear much about it anymore, but stock was up 6% in regular trading, up another 3% plus in aftermarket trading. So stock is up almost 10% at 120. It's trading through year highs. Yes, I know it's a tech stock, but at least it's one of the old line tech stocks, and that's doing very well right now. So what can I tell you? We have a market that is starting to spread out in terms of the upside. It's more stocks that are participating in the upside. That's an indication that there's a lot of energy behind the stock market. Not talking about the oil market, I'm just talking about buyers are right now frantically buying stocks because we got too negative. People stopped thinking that we could go to a year high, that the stock market actually goes up more than it actually goes down. And now that the market is showing positive returns in a pretty decent year, there's a chase going on called performance chasing. And now big investors who have overloaded too much on cash are in a rush to put that cash to work in the stock market. And they're going into other stocks that have not already had big moves, and they're trying to capture alpha by buying stocks that have not yet had big moves yet this year. It's getting harder and harder, by the way, to find stocks that have not had big moves yet this year. So let's just take a quick gander at how some of the major averages are doing, and then we're going to get going. The S&P 500 hit a 52-week high today and up on the year 13% on the year. Not terrible. Not the worst thing, but pretty good. And if you look at the Nasdaq 100, which is the biggest 100 non-financial stocks in the Nasdaq, that is up 35% now year to date. So to me, you almost should want to be doing less than the Nasdaq 100, because if you have the Nasdaq 100 or you're up 35%, it means you are very heavily exposed to one sector, and that's the tech sector. It's a dangerous thing because when techs do turn around, they turn around hard, and I've seen people get wiped out in technology stock investing. Haven't seen people get wiped out in too many other sectors. Nothing quite like technology. So when they're hot, they're hot. When they're cold. So just be careful out there. All right, that's it. That's the end of the live stream today. I thank you so much for joining me today, and I will be back tomorrow. And if you watch this in the replay, if you come up with any questions or you want to reach me, check me out on LinkedIn, Mitchell Goldberg. Check me out on Instagram at InstaMitchG. On Facebook, Client First Strategy. YouTube, Client First Strategy. Or just check out our website, clientfirststrategy.com, for all my contact information. And I'll speak with you soon. Thank you for joining me.